This is the Daily Market Comment by Marios Hadjikyriacos. I'm Maria Pachardis. Thanks for joining us at XM.com. Financial markets remain in a state of panic, with world stocks tanking on Monday to extend heavy losses from Friday as a worsening pandemic and mounting national lockdowns leave traders no choice but to continue pricing in a deep global recession. Germany became the latest major economy to tighten its social distancing rules, shutting down all non-essential businesses and banning gatherings of more than 2 people. Over in the U.S., the highly anticipated spending package that would hopefully negate some of the virus's economic impact failed to pass the Senate yesterday, igniting concerns of a drawn-out partisan battle at a time when stimulus is needed urgently. The negotiations between Democrats and Republicans will continue today, but the longer this process takes, the less effective the package might be in shielding an economy that is about to be hit by massive layoffs. In this sense, the most important economic release this week will be Thursday's initial jobless claims. Investors will be anxious to see whether consumption has already cratered, with people staying at home, leading to mass layoffs at restaurants, bars, and hotels. In financial markets, even though stocks have already collapsed, things might get even worse once official data for March reveal the true extent of the damage and multinationals start to downgrade earnings forecasts. In the currency arena, the defensive Japanese yen is outperforming on Monday as investors seek shelter from the virus storm. The Swiss franc hasn't been as fortunate, with data released this morning showing the Swiss National Bank continues to intervene forcefully in the FX market to weaken the currency. Across the risk spectrum, currencies of export-heavy economies are getting hammered alongside commodity prices. The Kiwi has been hit especially hard after the Reserve Bank of New Zealand announced overnight that it will launch a huge quantitative easing program to drive longer-term interest rates lower and stimulate the struggling domestic economy. The dollar, meanwhile, remains resilient near its recent highs, despite the Fed's best efforts to weaken it by opening billions in swap lines with foreign central banks, cutting rates, and ramping up bond purchases. This was today's Daily Market Comment. Thanks for joining us at XM.com.